What's up everybody, Gen X Dividend Investor here. In this video, I'm going to show you my monthly dividend income, both from my monthly payers and from how much in total I get each month. I'll then respond to questions I've gotten from people who ask whether the income from covered call ETFs is real, or even a good thing. So let's dive right in with this first of 3 screenshots of my tickers in Fidelity, taken on Sunday, November 2nd, and I've covered up a few things in red that I don't want to share, like my account numbers. You can see in total my portfolio is worth about 3.48 million US bucks, spread across 3 accounts. My IRA is at 1.54 million, my taxable at 1.72, and my wife's retirement account that I manage is at 220k. My wife actually has the separate 401k for years that we haven't merged into this one yet, as she still puts some hours in a job that it's at. She's been there for years and loves it, and works less than 40 hours a week. I've tried to get her to quit working and ultimately move somewhere fun, like Europe, but she wants the kids to be further along in school, and she absolutely loves getting to chit-chat with her customers she works with, so that's kinda cool, as I've never loved my jobs. But her 401k fund options really sucked, and we're basically going sideways for years in this bull market. I actually asked her if I could call her work up to see if they'd consider moving to a different retirement provider, but she didn't want me to rock the boat. Fortunately this year someone new came in and started changing things, including the company that manages their 401ks, so now they offer a retirement SP 500 ticker, which we moved our funds into. Anyway, I'm always a little hesitant to share portfolio updates like this because I know that while some people feel encouraged by them, others might not, and I really don't want to cause any negative feelings. So I'm going to ask you guys to leave me a comment and let me know if you think I should keep posting updates like this, or if it would be better to just share the tickers without the actual amounts. And beyond that, I sometimes get people who say things like, oh sure, all you gotta do is have a few million bucks and then you can make 150 grand a year in dividends. I completely understand that point of view, but it misses what really matters. I mean, I started investing with nothing. My net worth was negative because of loans, and I never received or inherited anything. But after more than 3 decades of staying consistent, I was able to build my portfolios to where they are today. Comments like that remind me of someone watching a person bench 405 and saying, sure, you can do that if you're huge, without realizing how many years of work and discipline it took to reach that level. The real message is not about how large my portfolio is, but about the steady path that led to it, and the fact that many people can follow that same path. So yeah, if you invest in decent assets for a long time, keep reinvesting, and stay consistent, you can build a solid portfolio even if you start from scratch like I did. And feel free to use the timestamps on screen if you want to jump around. But before I show you more of my portfolio details, let's take a look at some surprising retirement stats that show savings broken down by age ranges. I read that only about 15 to 20% of the people in the world own any stocks, so if you start investing, you're already ahead of the game. The key is to start and keep doing it until it becomes a habit. One of the easiest ways to begin, if you're eligible, is to open a Roth or whatever retirement account with a solid broker such as Fidelity or E-Trade and start putting in about 20 bucks a week into something simple like the SP 500. Later, once you get the hang of things, you can also open a regular taxable account. Keep living within a budget, and whenever you have extra cash, invest a little bit more. Make sure you pay off your highest interest debt first and set aside an emergency fund. Some people actually use their Roth as part of their emergency fund, and that can work, but there are a few risks to keep in mind if you go that route. The goal is to build habits that keep you financially steady, even when life gets unpredictable. And part of the reason I'm so passionate about getting people to invest is because about 54% of US households have no dedicated retirement savings. I'll show you median amounts saved, because averages can get skewed by a handful of very large accounts. Okay, so for folks under 35 years old, the median amount saved and invested for retirement is about 18,800 bucks. That means 50% of people under 35 have less than that saved for retirement, and 50% have more. In the 35 to 44 age category, the median amount saved is 45 grand. In the 45 to 54 range, which is where I'm at, the median amount saved is 115 grand. Then the 55 to 64 category has a median amount saved at 185k. The 65 to 74 bucket is at 200k saved. And the 75 plus age range folks are a bit down at 130k. That kind of makes sense because older folks are using their retirement savings, pushing the amount saved down unless they're doing well in the market. My neighbor told me he burnt through his retirement account and now he's back at work in his 70s. That's another reason why I prefer a retirement where you try to live within the budget of your investment income and Social Security or whatever, rather than have to sell your assets for cash. And dividends provide a natural budget you can work with, which I also feel is a healthy structure to have. Anyway, the data shows that if you've saved $1 million or more, then you're above what 97% of retirees are at in the US. Okay, now let's take a look at my tickers, and this time I sorted things by account. So this is page 1 of 3, starting with my IRA, and I'll just quickly flash these screenshots for new people who might think my accounts aren't legit. I have 29 tickers in total, and 5 of them pay monthly. So you can see Starbucks, Southern Company, SCHD, Realty Income, which is one of my monthly payers, then Procter Gamble, Pepsi, Kimberly Clarke, J&J, JEPQ, a CC ETF which pays monthly, followed by another monthly payer in GPIQ, and then Goldman Sachs, ExxonMobil, Duke Energy, Colgate Palmolive, Coca-Cola, and Chevron on this page. On the right, you can see Fidelity's estimated income for how much each ticker pays out per year in its account. I've not done a 72T yet for a variety of reasons, including because I want to preserve my principal in case I ever do a Roth conversion, and because I don't like to be locked into how 72Ts work, which means I pay a 10% penalty tax when I take my divvies out. Moving on, we come to page 2 of my tickers, which span the remainder of my IRA account, my wife's rollover account tickers, and then the beginning of my taxable account tickers. So Caterpillar, BTI, IDVO, which is an international CC ETF that pays monthly, its brother ticker in DIVO, which is my 5th and last monthly payer, then Altria and AbbVie as the final ones in my IRA. Then we move into my wife's retirement account with Travelers, Realty Income, J&J, Home Depot, BTI, Altria, and AbbVie. So yes, I own certain tickers in multiple accounts, and I'll show you the totals in my spreadsheet tool. Then we have my taxable account tickers, and you can see Southern Company, SCHD, Realty Income, Procter Gamble, Philip Morris, Pepsi, and Microsoft. And finally page 3, which holds the remainder of my taxable account tickers. So McDonald's, Kimberly Clarke, J&J, GPIQ, ExxonMobil, Enterprise Products Partners, Duke Energy, Colgate Palmolive, Coca-Cola, Chevron, BTI, Apple, Altria, and AbbVie. You can see it says in total my portfolio adds up to $3.48 million, and Fidelity estimates that my tickers generate about $150,000 in dividend distributions each year. My spreadsheet estimates that I make about $151,000 a year, which is actually more accurate as I do things like incorporating changing currency conditions in real time, amongst other things. So now let's look at my positions in my spreadsheet sorted by largest to smallest, and this is page 1 of 3. On top I have Realty Income, and I have 3,795 shares of it, and it's 6.3% of my portfolio. And that position is worth about $220,000, and it pays $1,022 a month, or $12,200 a year. Next is SCHD, followed by Altria, AbbVie, Microsoft, J&J, and then my first CC ETF in GPIQ. It pays about $1,274 a month on average, though its payouts fluctuate. Then is another monthly payer in JEPQ, and it averages about $1,341 a month. Then another monthly payer in DIVO at $601 a month. And then I have EPD. EPD actually pays me this month on November 14th, and they'll pay me $2,607 for the quarter, and I don't pay any taxes on it for like the next 7 years, and it alone basically covers my entire mortgage for the month. Moving on to page 2, and I have BTI, Goldman Sachs, Duke Energy, McDonald's, Procter Gamble, Coca-Cola, Pepsi, Southern Company, Philip Morris, and ExxonMobil. Then we finish off with Caterpillar, Kimberly Clarke, Apple, Chevron, Colgate Palmolive, IDVO, which pays me about $189 monthly, then Travelers Insurance, Home Depot, and Starbucks. In total, I have 45,752 shares of tickers worth about $3.48 million that yield about $151,000 of dividend distributions a year. My portfolio's average weighted yield is 4.35%, and my portfolio's average weighted 3-year dividend CAGR is about 5.3%. I've been noticing that lately dividend hike growth rates are slowing down, which is usually a sign that either companies aren't performing as well as they'd like, and or that they're having concerns about the economy and so they're scaling back. Fortunately, they're still doing hikes. Like, check out all the ones I've gotten this year and the order I've received them. First was EPD that announced a 3.9% increase over last year, and this was its 28th consecutive year of dividend increases. Then Kimberly Clarke did a 3.3% one, and this was its 53rd consecutive year of dividend increases. I should probably do a video about the recent acquisition of Kenvue. Then Chevron did a 4.9% hike, and it's increased its dividend for 38 consecutive years. Pepsi did a 5% one, which was their 53rd consecutive year of increases. BTI did a small 2% one. Then Realty Income did a 1.5% one, and they normally do multiple small ones throughout the year, and this was their 30th consecutive year of dividend increases. Coke did a 5.2% hike, which was their 63rd consecutive year of increases. Home Depot did a small 2.2% one. Then Realty Income did another increase, this one at 0.2%. Colgate Palmolive did a 4% one, and this was their 63rd consecutive year of dividend increases, and they've paid dividends every year since 1895. Procter & Gamble did a 5% hike, and this year was its 69th consecutive year of dividend increases, and they've paid dividends every year since 1890. Then J&J did a 4.8% hike, and this was their 63rd consecutive year of increases. Then Travelers did a 4.8% hike. Southern Company did a small 2.8% one, their 24th consecutive annual hike, which means I bet they become an aristocrat next year. Then Apple did a 4% one. Realty Income did another increase, this one again at 0.2%. Then Caterpillar did a 7% one, and this was its 32nd consecutive year of dividend increases. EPD announced another small increase for the year. Then Duke did a small 1.9% one, its 21st consecutive year of increases, and its 99th consecutive year of paying divvies. Altria did a 3.93% one, its 56th consecutive year of increases. Then Realty Income did yet another small one. Then Microsoft did a 9.64% hike. Philip Morris did an 8.9% hike. Starbucks did a small 1.64% one as the new CEO tries to turn things around for them. McDonald's did a 5.1% hike, its 49th consecutive year of doing them, meaning next year I bet it becomes a dividend king. Then ExxonMobil did a 4.04% hike, its 43rd consecutive year of doing so. And finally AbbVie did a 5.5% hike, its 53rd consecutive year of increases. And those are all my stocks, and then SCHD has been doing hikes as well. But anyways, I can tell that companies have taken the accelerator off their dividend increase amounts on average. And my conservative portfolio tends to do better in bad markets, like during crashes and then when we go sideways, and I tend to underperform in bull markets, like the one we've been in. And remember, I'm spending almost all of my dividend income each year, which means that I'm not only taking out that $150 grand, but I'm also not reinvesting it. I say almost because I'm taking out about 20% of my ETFs and reinvesting that back into themselves. So focusing on my monthly payers, I make a little over $4,400 a month just from them. And then this view shows me that I make about $12,619 a month when I include my quarterly payers. That means I get paid about $2,912 every week on average, which is about $415 a day, or $17.29 an hour, every hour 24 by 365. And note, about 15% of my portfolio is in covered call ETFs. Interestingly, JEPQ tends to pay on the first week of each month, GPIQ in the second week, Realty Income usually in the second or third week, and DIVO and IDVO in the fourth week. That being said, it really shouldn't matter too much when your dividends pay out, because you can just budget your spending and use them however you want, though I recognize it is motivating and nice for compounding to see it come in faster. Let's use a simple compound interest calculator to show you what I mean, though if we wanted to be more precise, we would model in dividend yield, share price appreciation, dividend CAGR, and stuff like that. Okay, let's pretend we have a $100,000 investment at a 10% return, compounding monthly, and let's say you invest $1,000 a month, and then after 10 years you'd end at $475K. Now if we change things to where we're compounding quarterly and we invest $3K a quarter, then after 10 years would end at about $471 grand. So monthly investing and compounding took us to $475, and quarterly investing and compounding took us to $471. So yes, faster compounding matters, but usually not as much as the quality of the investment. My point is not to be blinded by how frequently something pays out, even though it's cool to see our payouts showing up more often. Okay, now let's look at my monthly dividend income over time, and let's include my quarterly payers in there. So looking back at May, I got $11,464 in dividend distributions. In June, I got $13,887. In July, it dipped down to $9,475, then up to $11,160 in August. And if I expand this view to also show my tickers, then you can see in September I got $14,239, then $10,999 in October, and I should get $12,483 this month in November. Looking forward, I should get $14,146 in December, followed by $11,228 in January, $12,483 in February, $14,389 in March, and $10,985 in April. Those future payouts can fluctuate based on any dividend hikes or cuts that happen, as well as due to my ETFs paying out differently than they have been, which is actually one thing I dislike about ETFs. I mean, it's annoying that ETFs payouts often fluctuate, whereas my classic blue chip dividend stocks just tend to keep paying the same or more. Anyway, it's visually pretty easy to spot my monthly payers in this section of my spreadsheet tool, as each month is filled out with a payout. Like Realty Income on top pays out every month, as does GPIQ, JEPQ, DIVO, and IDVO. And then this is my historical dividend monthly income over time since I started this spreadsheet in January of 2020. And you can see how my income's been trending up over time. I expect my CC ETF payouts will materially dip once there's a big market crash and things have settled down, but I expect most or all of my stocks will continue to pay out and do increases. And if they don't, I'll probably sell and move into something else. Looking forward, this is what my estimated dividend income growth might look like over time, with the blue bars being if I'm spending all my dividends instead of reinvesting them, versus the red bars showing how my annual income could grow if I was reinvesting and I got increases like I have been lately. So like in 10 years from now, I'd be making about $250K a year if I continue to spend my divvies, or about $375K a year if I've been reinvesting along the way. And since I've showed you some of my covered call ETFs, and because lately I've gotten a bunch of comments asking for my take on income from options, both in general and from covered call ETFs, so let's dive into them. In fact, one guy said that he heard that doing options wasn't real income, and then this guy asked for my feedback because a financial advisor on YouTube was claiming that income from CC ETFs wasn't real, amongst other things. Now, I used to run the wheel strategy to generate income from my positions, both on dividend stocks and non-dividend stocks, so I can confidently say that it's income. You can check out my older videos if you want to know why I used to do them, and why I no longer do. So my first question is what someone means when they say real income. I mean, if someone makes money trading or selling options, then that's income in every legal and financial sense. At least the IRS says so. Doing things like selling covered calls, writing cash-secured puts, or closing a profitable position are all generally taxable. Sure, it's not exactly the same as earned income from a paycheck, but it still increases your wealth. It's considered investment income, not wage income. And no, broadly speaking, you can't use it to qualify for IRA contribution limits, but it's still real income or money that's often taxable and spendable. I have a lot of people in my dividend Discord community who make meaningful income from trading options. And like anything, you can do it intelligently, manage your risk, and generate consistent yield, or you can overreach and lose. And I feel that a similar logic applies when you outsource the work to a covered call ETF. You're basically paying professionals to run option strategies and handle the execution for you. So the cash flow from CC ETFs is indeed real, generally speaking. I mean, when a covered call ETF sends you a distribution, that's genuine cash in your account. My guess is that some confusion comes from where the money originates and whether it's sustainable. Advisors who claim a fund's distribution isn't real might be referring to a portion categorized as return of capital, or ROC. This typically means that some of the payout comes from sources other than dividends or realized gains, such as selling a portion of the fund's holdings or recognizing option premiums you haven't yet been taxed on. But return of capital isn't a trick. It's simply a tax classification that indicates part of the distribution didn't come from dividends or realized gains that year. Sometimes ROC does represent a part of your initial investment being returned. Other times it's just an accounting or timing difference, like when a fund earns option premiums that haven't yet been recognized as taxable income. The important warning is that if a fund consistently pays out more than it earns and has to draw down its own assets to maintain a high yield, that's called destructive return of capital. This practice can gradually reduce the fund's ability to generate future income. From a tax perspective though, ROC is often favorable because you don't pay tax on it right away. It lowers your cost basis in taxable accounts, deferring taxes until you eventually sell the investment, or until you get to zero. The income you receive is still real cash flow, but it's treated differently for tax purposes. Options premiums, on the other hand, are usually recognized as short-term capital gains once the position is closed or expires. That can result in less favorable tax treatment than qualified dividends, although that depends on how the strategy is managed and how often positions are traded. Of course, sustainability isn't just about how the income is labeled. Some covered call ETFs can see their net asset value, or NAV, decline over time if their distributions regularly exceed what the portfolio earns. Even if the cash flow feels steady, the fund's underlying value may be shrinking. It's kind of like taking more from a savings account than it earns. It looks fine at first, but over time the balance runs down. Another warning sign is when a fund borrows or uses leverage to maintain its payout level. That can make the yield look attractive in the short term, but also adds meaningful risk, especially when markets pull back or volatility spikes. Healthy, well-managed funds usually let their distributions fluctuate with market conditions instead of forcing a fixed high payout. A steadily declining NAV or heavier reliance on leverage just to sustain income can be a sign that the payout isn't as durable as it appears. So always dive into the details of anything you want to invest in to make sure you understand how it works and the risks it has. But to me, the debate isn't about authenticity of income, but instead about sustainability. I mean, the income exists, and that shouldn't be the question. What really matters is whether it sustainably continues. And that's kind of where covered call strategies come in. They're often designed to trade some upside potential for recurring option premium income, which can be relatively consistent but still varies with volatility and market conditions. So if advisors are saying they aren't real because they're comparing them to growth funds that only care about total return, then that misses the point. I mean, CC ETFs are made for people who care about cash flow, not just maximizing total returns down the road. So yes, covered calls usually underperform their underlying index or ticker. But again, total returns isn't what most CC ETF investors are prioritizing. They usually think of things like cash flow, maybe smoother returns, lower volatility, and stuff like that to varying degrees. Beating the market isn't what many of them are focused on, and giving up some upside for more recurring income isn't a flaw. It's usually a conscious trade-off. Sure, some folks invest blindly without understanding the trade-offs, but that's true for every investment. Advisors also probably point out that covered calls don't protect the downside and they cap the upside. And that's true, but what that ignores is that the option premium you collect upfront is real cash. It's an instant cushion against smaller losses. That premium tends to arrive when markets go up or down. And for retirees or income-focused investors, that may matter more than capturing every bit of market upside. A concern for some retirees isn't necessarily missing out on a nice rally, it's facing a big drawdown early in retirement that throws off their overall plan. But steady option income can help reduce volatility, which reduces sequence of returns risk and can make a withdrawal strategy more sustainable. Or advisors may say that CC ETF income isn't true income because it's just a restructured form of total return. But that's often kind of the point. I mean, CC funds are packaging part of their return in a way that's easier to use for some folks. It's not fake, it's just designed to turn your investment into hopefully a recurring paycheck. That's valuable for people who need to fund their lifestyle without constantly selling shares. And if total return was the only thing that mattered, everyone would just go all in on the single highest performing asset, right? I mean, historically, that would probably have been Bitcoin. But I'm guessing advisors don't promote going all in on Bitcoin, partly because deep down they know investing isn't just about historical total return math. It's about matching risk and diversity and time horizon and beliefs and stuff like that to each investor's goals. But real people do invest in bonds, CDs, dividend stocks, etc., not because they'll always outperform, but because they have different risk tolerances, goals, timelines, etc. And I think covered call ETFs can sometimes fit into that mix. They usually offer higher income than bonds, can have less volatility than pure equities, and potentially offer a smoother ride overall. Of course, each CC ETF is its own beast, with some not being at all sustainable, but I'm just generalizing. There's also a real measurable factor called the volatility risk premium. Option sellers sometimes earn excess return because implied volatility tends to be higher than realized volatility. Covered call ETFs can systematically harvest that premium. It doesn't mean they'll outperform stocks, but it's an additional rational source of return that critics tend to ignore. Another thing advisors can overlook or discount is behavior. I mean, one of the big reasons investors fail isn't low returns, it's bad behavior. They panic, sell at the wrong time, or chase what just went up. But regular cash flow often helps prevent that. I mean, when you're getting paid consistently, you're less tempted to abandon your plan. Covered call strategies can help create behavioral stability, which might be more valuable than theoretical alpha. Another thing advisors may bring up are fees, though that's kind of ironic to me. Now, covered call ETFs do usually cost more than simple index funds because there's active management involved, because you're paying for their expertise, their time, and blah blah blah. So they deal with all the execution and distribution work so you don't have to, and for many people, that's a reasonable trade-off. Now, I'm not a fan of going all in on CC ETFs, but I think it can be fine to own a percentage of them in your portfolio if you want to gas your income while understanding the trade-offs of doing so. Yes, if markets crash, distributions will probably fall as volatility stabilizes afterward, and recovery may take longer. But for people who value passive cash flow, that's often an acceptable trade. I think a reason many advisors push back on these funds is that a main part of their framework understandably revolves around maximizing total return. At the same time, it's a little funny to me. I mean, most advisors underperform the SP 500 over the long run, yet they criticize some products that serve investors with different goals. If their core advice is just buy the SP 500 and hold it because that's probably your best return, well, that's cool, but then again I bring up Bitcoin. But we all know that investing isn't a one-size-fits-all. It's about what fits your goals and your comfort level. That's why it's funny when those same people dismiss dividends or covered call income as pointless or not real or whatever, while at the same time there are plenty of investors who live off those distributions. They're using their investments for their intended purpose for them, which is cash flow. So at the end of the day, the income from options is real. The distributions from covered call ETFs are real. The meaningful question isn't whether they're real, it's whether they're sustainable and right for your goals. If your focus is maximum total return, then sure, those funds probably aren't for you. But if your focus is some cash flow, maybe a smoother ride, then specific covered call ETFs can be a smart and defensible part of your portfolio. There are thousands of ways to reach financial independence. Some people do it through growth, some through income, some through real estate, and some through crypto. The key is to understand what works for you. Keep learning, stay curious, and build a plan that fits your life, not someone else's philosophy. And with that, I ask you to please do me a favor and hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Now please leave me a comment and tell me what your thoughts are on monthly dividend income. Is that something you strive to get, or do you not care at all about it? Now I'd like to call out that Seeking Alpha, which I'm an affiliate of, is running a Black Friday deal starting November 12th and going until December 10th. Their premium subscriptions are $60 cheaper, their alpha picks are $100 off, and they have some other great discounts. Check out my link in the description below if you'd like to sign up. Moving on, now I'd like to show my gratitude to subscribers who left me kind comments, so I'm going to shout out 10 who've done just that. So thank yous go out to Philip Russell, Gene Milfort, Rich Diaz, Dodgerman11, Jake Chisel, Blockbuster 2774, Louis Idoraga, Crypto Hotep, and multiple from Norfolk Paul, and multiple from Bitstream. Thanks folks, I really appreciate it. Now I'd like to pitch my FastGraphs affiliate link along with my coupon code in the description of this video, as using both will allow new users to get 25% off their first payment, even if they sign up for a full year. Also check out my Patreon page, and or consider joining my channel membership, as both have some cool perks you might like. Finally, I'll close this off by recommending that everyone join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 86 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.